With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks.
All right, everyone, let's break down what happened with the Fed today. The Federal Reserve cut interest rates by a quarter point, bringing the target range down to 4.0 to 4.25%. But here's the key. Chair Jerome Powell made it clear this wasn't the start of a big easing cycle. Powell stressed that the Fed is now in meeting-by-meeting mode. Translation: future cuts aren't guaranteed. They'll depend entirely on the incoming data. Now, why the caution? The Fed's in a tough spot. Inflation is still running hot, thanks in part to tariffs, while at the same time, the job market is cooling. Unemployment has ticked higher, and job creation is slowing. That's what Powell called a two-sided risk, where there's no easy policy choice. According to the Fed's own projections, officials expect up to 2 more cuts later this year, but Powell warned those projections are conditional. If inflation stays sticky, or if the job market stabilizes, they might hold off. On politics, President Trump has been pushing hard for deeper and faster cuts, even clashing with the Fed board. Powell downplayed that, saying the Fed's decisions are based purely on economics, not politics. Market reaction? The dollar bounced back once Powell started talking, and Treasury yields edged higher. Investors saw his tone as less dovish than expected. Basically, the Fed gave a risk management cut, but didn't commit to an easing spree. Bottom line, today's cut is insurance, not a pivot. Woes. The Fed is walking a fine line between fighting inflation and supporting jobs, and that means more uncertainty for markets ahead.